So when I was working January 2nd, so yesterday.
Yeah.
And then you needed 150. Yeah, I averaged 30.
Yeah, we did. Plus I do all the stuff with my kids.
Back. It was a very quiet Wednesday, or a very quiet Monday, excuse me. It was very quiet.
You should have sent out that email saying.
I know. I said next time I won't send out an email. I'll just drop it. I'll just drop an email to somebody who's going to be here and go, okay, I might be late. But there were 6 people that showed up. 7? Oh, that's right. That's right, because he came in late.
Okay.
Yeah, but he actually had classes. He showed up.
That means I might not have missed that much.
Well, I did a normal, actually, I would argue that it might have been a somewhat more useful class since it covered final exam stuff. But yes, it's recorded. Yeah.
Could you say how to get to it again?
Yeah.
It's just on Moodle, isn't it?
I normally post them up to Moodle, but it takes me until I get to the weekend when I can actually sit down and post stuff up to Moodle. So it's on my YouTube channel. Oh yeah. All right, so I'm going to get rolling, and we're going to, I believe, today mercifully complete capital structure and dividend policy. Before we get started, I want to remind you of a few things administratively. So we've got the Monday night before the final. So the final is the Tuesday of finals week, 10 o'clock in this room. The Monday night before, at 5:30 to 7:30, I'm going to do a finals review in this room. So there's a couple things that, again, I'll kind of give you an up to speed on before you get to Tuesday morning if you're going to show up on Monday night, but I want to cover a couple of those topics again. I'm going to cover them probably every class from here on out to make sure that folks know kind of where the emphasis is going to be and what the final looks like. Based upon last night's, my run through of a final last night, the final will be 2 questions, not 3, of the put stuff together and work it through in Excel. And it's going to be 20 multiple choices. The 20 multiple choices are going to be relative, there's going to be no math multiple choices. So the 20 multiple choices are going to be, and I had kind of given the folks who were here on Monday the example of finance is a combination of blank, and one of your multiple choice questions may be expected future cash flows and risk, or something along those lines. So it's really trying to get to the concepts. Yes, ma'am.
Will we be allowed to have a note card?
You'll be allowed to have your computer, the internet, the note card, page of notes, book. No, that's the only thing you can't have is the teammates. But basically, all resources for the final are at your disposal, with the caveat. And I've said that. Yes, ma'am.
I was just wondering if it's going to be like the quizzes to where we have to get a question done and then we move on.
No, it's going to be so. Good question. So here's how the final will generally work. You are going to receive a pack of paper. We are all of a sudden now in a little bit different environment because it's a finals environment and I have different record keeping requirements. So you will receive a pack of paper. The pack of paper will have the multiple choice questions. So you'll be able to answer them in any order you want, not answer a couple, answer them all, put A's for everything. It doesn't matter. Well, it matters on the grade, but it doesn't matter on how you approach it. You can do the the problems first, or you can do the multiple choice questions first. It's all going to be on paper. What my expectation is that, and I'll walk through this again Monday night and Tuesday right before the final. What my expectation is that you'll answer the multiple choice questions on a piece of paper by circling the correct answer. And on the problems, you'll put the answer to each of the questions of the problem. And those of you who have come into my office have seen a few prior examples of final exams, and I will walk through one that Monday night, one weighted average cost of capital, one capital budgeting problem, so that you have a feel for what you will probably be seeing the next day, and also what the expectations are on how I like to see stuff done. Normally on the piece of paper, you'll put the box answer. So it may say, what's the weighted average cost of capital for Microsoft? And you put on your piece of paper 10.75%, you'll put a circle around it. Sitting at your computer, or sitting at these computers, you have access to Excel. You have access to your university email. My expectation is that you'll do the work in Excel and you will email me your Excel spreadsheet. So instead of showing your work with a pencil all over these pieces of paper and erasing it and that kind of stuff, I want folks, and I've said this kind of from day one, to be comfortable enough in Excel to be able to actually do the problems in Excel. So the two problems that you'll have in Excel, one is a weighted average cost of capital problem, one is a capital budgeting problem. So you now know your two big problems on a final. They will count for 60% of your grade, 30 points each. You will do those in Excel and email that Excel spreadsheet to me at the end of the final. I will grade off your paper, and if your grade or if your answer on your paper for a part of the final doesn't match what my answer key says, I will then open up your spreadsheet and I'll see if you used the right format, the right formulas, the right inputs, whether it was a typo, whether you just did something X, Y, or Z wrong. In many cases, when folks have actually done what I've just described, they end up getting a minimum of 70% of the points available on the problem, even if they completely hose up the problem, because I can at least see where they completely hosed up the problem. And then go, okay, you've missed this piece, and you'll see, and those of you who have walked through these problems with me know that they build on each other. So you start with, okay, what's this, then what's this times this, and what's this times this times this. And so if you miss the first one, you'll miss the second one, the third one, the fourth one. You'll get full credit on the second, third, and fourth one because you know what you're doing. You just got the wrong answer to question number 1, which then flows through to question 3, 4, and 5. So I'll give you full credit on 3, 4, and 5, but not on question number 1. So do the work in Excel. If you're not comfortable in Excel by now, you've got yourself 2 weeks. Figure out how to do weighted average cost of capital and capital budgeting at a minimum in Excel. If I were a betting man, I would not only assume that those are the two problems, as you've now been told that 5 times, but I would also have built out the templates that I would use for a capital budgeting problem and a weighted average cost of capital problem and have them available to you. I would have the notes for weighted average cost of capital and my cheat sheet for key equations and inputs for weighted average cost of capital and capital budgeting ready to go between now and the final. As you're studying for the final exam in this class, I would focus my studying on doing some practice problems, and you've now got a whole set down at the bottom of May. You can see that there's a bunch of quizzes open that never close. They can take as many times as you want. They don't count for a grade, where you can just start cycling through problems and go, okay, there's a capital budgeting problem. Let me do it. 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 Let me do another one, until you're comfortable and you've got a template that's built out that works. If you've got that, you're going to find that getting through this exam with a good grade is going to be relatively straightforward. I'm not going to say it's easy because there's a lot there, but it's not going to be horribly difficult. If you walk in on Tuesday and you haven't built out the template and you haven't kind of got yourself organized after the professor has told you exactly what the two problems are on the exam, you will not finish in 2 hours. There is no way you will finish this exam in 2 hours if you're at least not somewhat prepared for a capital budgeting problem, weighted average cost of capital problem, and you've kind of got and you're not having to flip through books and magazines and the internet and Google to try and build this thing out. So I would have those two things. I can't stress enough. I'd have those two spreadsheets at a minimum ready to go. So you may have to add periods, or you may have fewer periods. You know, you may build it for 10 and there's only 4 periods. You can adjust that easy. But if you don't know what capital budgeting is or what weighted average is, and all of a sudden you're being asked to calculate a weighted average cost of capital, and there's a weighted average cost of debt, and there's an effective tax rate, and you've got to calculate the after-tax cost of debt, you've got to calculate what the weighted amounts are based upon a balance sheet, and you don't know what the hell I'm talking about right now, you're going to have a problem on the final exam. So get yourself somewhat comfortable with those concepts and build it out and do practice problems. Don't worry about the multiple choice pieces. I think you're going to find that those are going to be relatively straightforward answers. They're not going to be horribly difficult. All I would ask is that you do your best on this thing. Historically, the grades on the final exam have ranged from 24% when I've given it up at JBLM up to 125% without the curve, because there's extra credit questions on the final as well. So if you get done early or you're bored, you can do some extra credit questions.
What are the extra credit on?
The extra credit questions.
Another problem.
No, the extra credit questions have always been on the problem that you just did, and it's either, you know, calculate. If I've got a calculate a weighted average cost of capital, and you've got X, Y, and Z, I may say, you know, is that weighted average cost of capital higher or lower than the required market rate of return? Or I may have one where, you know, what's the actual? I'll give you an answer. Like, for instance, assume that the cost of debt, or actually a CAPM question, assume that the beta is 1.2. And then I'll go look up the beta on Yahoo Finance. What's the beta? What's the actual beta? Because I'll give you one that's easier to calculate. The actual beta may be, you know, 1.175. And so I'll go, you know, click a link and tell me what the actual beta is. So it'll be stuff like that, a couple points. So I had somebody did exactly what I said to do. She put the entire thing, had it ready to go. She powered through a 4-hour final in about an hour and 15 minutes. Did all the extra credit.
Wait, 4-hour final?
That was what it was up at JBLM. Yours is 2.
Sure.
Yeah, yours is 2. JBLM's was 4. And essentially was able to get 125%. I do curve the final. So if you got a 24 on the final, you're not getting a 24 most likely unless everybody else averaged out about 82 or 83%. You're not getting a 24 on the final. So I do take a look at the final. I take a look at the grade distributions. I do the standard descriptive statistics of mean, median, mode, and range. And I go, okay, I'm going to have generally the median grade in the class is going to be a B+. So I'm going to make sure for the final exam that the median grade in the class is around a B+. And then I do a distribution off of that, and I go, okay, if, and this is an if because I have failed folks in this class, but if the person, and this is just important for you, if you get frustrated and upset and irritated and get a little bit of test anxiety on Tuesday, because some of us struggle with tests, period. When you go to take that test, do the best you can and try and answer every question. Where I will not have a lot of tolerance is when you've got 20 multiple choice questions and you don't even try and answer them. I mean, at that point, just put A, and get yourself done. But I've had folks who basically got to the point where they were, you know, kind of gave the 2 middle fingers to the final. And they said, okay, I'm just not, I tried question 1 and 2. I can't forget this. I'm not even going to try 3, 4, and 5. That's not, that doesn't go over well with me. Now, if you struggle and you go, I tried question 1, 2, 3, 4, and 5, and I did my best. I tried to do what I could do, and you ended up with a 24, that normally, in my world, will minimum grade out to a C-. So no one in this class who attempts the entire final and puts an honest effort into it, and I can generally tell when I'm looking at spreadsheets and answers, is going to get less than a C- on that final. You're only going to fail the final if you don't put the effort in. I will not allow someone to fail the final as long as they're putting the effort in. I tend to look at it, you know, the way I look at it, folks, is if the average grade on the final is 54, that's the professor's fault, not the student's fault, because I either made it too difficult a test, or I didn't teach the material well, so I'm not gonna penalize an entire class for my failings. So I do tend to kind of midpoint the thing out, do a normal distribution. If you are struggling in this class, but you're putting the effort in, you're showing up, if you're struggling, you show up to office hours, you ask the questions, you do what you need to do, you participated all along, you've done all the quizzes, you ain't gonna fail. I said that day one, and I'll say that here on like day 60. Any questions on final stuff? I know it's getting to that point of the semester where folks are like, I just need to be done. So I also know that most of you are carrying course loads from 3 to 6 classes. And so it's not an easy, and I've been there before in the not so distant past. So I recognize the kind of the how do I prioritize and what should I do and how do I focus my efforts. Capital budgeting, weighted average cost of capital, focus on those 2 things, and then try and drill yourself down on some of the concepts that we talked about. Things like this, things like the thing we talked about for the last 2 weeks, lend themselves well to multiple choice questions because there's no math. It's, what type of theories, here's 3 theories, and one might be, quantum theory and something else. What's a dividend payout theory? And just understand, or I may give a description of a dividend payout theory and go, is this quantum theory? Is this mechanics theory? Is this stable dividend theory? They're not going to be horribly difficult questions. You'll normally be able to eliminate 1 or 2 answers right out the gate. You'll have 2 answers left. If you know what you're doing, you should be able to do well. Any questions? Okay. So let me mercifully attempt to wrap up dividend policy and capital structuring. So the last thing we talked about on Monday, for the 7 folks who showed up Monday, God bless you all, because I walked in and I was like, oh, I guess it's gonna be a light day. The recording, by the way, is on YouTube, on my YouTube channel, and it will get posted out to Moodle this weekend when I sit down and update stuff to Moodle. So you can watch or listen, but in the event that you really don't want to watch or listen, I'm going to cover in 2 minutes the last slide, which was you've got elements where dividends get paid or dividends are declared, or you wanted to pay a dividend and you can't. And so those are constraints on dividend payments. So you've got constraints like the debt says you can't pay dividends unless you earn a certain amount of after-tax cash flow. And so you may declare a dividend and say at the end of next quarter, we're going to pay 25 cents a share. And then all of a sudden you go do your financials for that quarter and you didn't clear covenants or contract restrictions. They're called covenants in the real world. At that point, you may have to undeclare your dividend. The board may essentially say, hey, we're not able to pay the dividend because it would violate bank covenants. If you pay the dividend, you're default on the debt, which the bank could force you into bankruptcy, so you really don't want to do that. For dividends, you can't pay out more in dividends than you have in retained earnings. So you can't pay out additional paid-in capital. You have to pay out of retained earnings because dividends are the owner's share of earnings, which is retained earnings. So once you get to 0 retained earnings, technically you're not paying out dividends. You may be returning capital, but it's not a payment of a dividend. Cash availability. If you declare a dividend at 25 cents a share, and it's going to cost you $250,000 to pay out, and you only have $100,000 in the bank, that constrains your ability to pay the dividend. And then the IRS, and this is where things get kind of interesting. The IRS requires companies to pay dividends and not just accumulate big wads of cash. We discussed a little bit about why that is. So of these 7 people who showed up on Monday, who wants to tell the rest of the class why the IRS forces companies to pay dividends when they begin to accumulate piles of cash?
Tax.
Talk to me, Jace. What about the taxes?
Well, they want to be able to tax the income that you pay out. If you keep that cash, they can't tax it.
Okay, so double taxation. Double taxation. So here's the deal. When a company earns money, they pay income tax. We've seen, what's the effective tax rate. We factored into things like depreciation and interest cost. When the dividends are paid, so if I'm going to turn around and pay a dividend to Seth, and Seth's going to get $1,000, the company paid dividends on that or paid taxes on that already. I go hand Seth a check for $1,000, and the IRS is going to tax him again on $1,000. If I don't pay that $1,000 to Seth and I hold it in the company, the IRS never gets that second bite of the apple. They never get to tax the earnings of the company and then tax Seth on the distribution of those earnings to Seth. The effective interest rate on or the effective tax rate on a dividend used to be ridiculously high. So it used to be dividends were taxed at ordinary income rates. So the company would pay a 35% income tax on the earnings, on the retained earnings. And then when I paid it out to Seth, he would pay a 40% tax rate on that at ordinary income tax rates, which meant that the corporate earnings were actually effectively taxed at 75% before they were distributed to shareholders. LLCs, S corporations, and other pass-through entities were created to kind of work around that. Now there were limitations, historically limitations on S corps and the number of shareholders you could have, and you had to be U.S. persons. But it's all driven by tax policy. So the IRS says, look, you can't have your own little private company as a C corporation, as a regular corporation, accumulate a bunch of cash in it and not dividend it out or pay it out as wages. Otherwise, we're going to come in and tax you as if you had paid it out because we want our money. So improperly accumulated retained earnings is an IRS way of saying you either need to pay your people more and pay it out as wages, or you need to pay it out as dividends, because if you have too much cash, you're not allowing us to tax it again. And so, yeah, so at the end of the day, that's another factor that influences dividend policy. As a practical matter, it's rarely enforced. Companies can make the argument that we're saving for a rainy day. They can do projections that show, high, medium, and low economic factors, or we're looking to do an acquisition, or we have increased working capital. The IRS uses this more as a stick than and an infrequently used one, but it's something to keep in mind. There's some other, and these are the other components. So what the IRS would look at is going, okay, you're improperly accumulating cash, and you as managers would go, well, no, I'm not, because here's some other things that I needed to keep in mind, which is why I'm retaining cash in the business. So each one of these factors that influence dividend policy, if you're actually stuck sitting in front of the IRS, you would be able to then use as a rationale for not paying out the dividends or paying additional wages. And generally the IRS backs down because there's this thing called business judgment rule, which essentially says if you're the management, unless you're doing something obviously wrong, the courts tend to side with management and go, well, that's your judgment. You might have bad judgment, but that's not illegal. So investment opportunities. So the available of good capital budgeting projects affect the amount of dividends paid out, because if you've got great opportunities to reinvest that money in new products, in new equipment, in mergers and acquisitions and other things, so all the capital budgeting work that we've done, you go, hey, I need to keep this cash. I might not have enough this year. I might need 2 or 3 years, but I'm trying to build up this cash because we're looking at building a new building. We're looking at expanding our business. We're looking at acquiring another business, expanding a product line. And so you use that determination, a long-term 3 to 5 year strategic plan for your business or operational plan for your business that goes, hey, I've got to look and see what my cash flow forecast is. That may not make sense for me to pay dividends out today. It may not even look like I'm hitting my hurdle rate of return today, because my required rate of return on retained earnings might be 18%. I'm only getting 2% or 3% on this money that I'm keeping. And you would factor that into, at some point in the future, my expected future cash flows are going to go up by higher than that. And you would take your earnings or operational earnings in each of those periods, and you would look forward and make that determination that you exceeded your hurdle rate. Alternative sources of capital. So if you've got, and we talked about this in light of your person, if you've got a credit card or you've got a home equity line of credit, you may be able to keep less cash in your savings account, because if big times get tougher, you need additional money, you just draw your savings account down, or you draw your line of credit, or you charge down your credit card. If you don't have those things, you probably need to have a bigger savings account in case something goes bad. And so companies, their savings account is their cash. And so if they've got alternative sources of capital, if they've got lines of credit that they can draw, or if they've got the ability to access the stock market relatively easily, they may be able to pay out more in dividends because they need to keep less in cash reserve in case things go bad. If they don't have those things, they don't have access to alternative forms of debt or equity capital, they may need to reserve more cash. And you can make that argument if you have to for excess retained earnings. Ownership dilution, what does that mean? Say again?
Maybe there's too many owners.
You're on the right track. You want to try and dig around in there a little bit?
I'm gonna know how to say it.
Okay, so let me give you an example. Let's say Clay and I own a business, and I own half and he owns half. And we want to go get alternative source of capital. We want to go out and we want to raise some additional equity. And I decide I'm going to bring in Jason. Now, Jason owns a third, I own a third, and Clay owns a third. My ownership got diluted. I used to own half the business. I only own a third of the business because I had to go out and get an alternative form of capital, which was.
If you owned 50 and you brought him in, how did it now become 33?
Well, we bring him in. The company brings him in as a partner. Yeah, or I sell my 25, I sell half of my half. But normally if there's going to be restrictions on that too. But ownership dilution is essentially going, hey, we're going back out to the market, we're bringing in new shareholders. And if I own, under that scenario, I own 60%, Clay own 40%. Then I bring in Jason, or Jason comes in for a third. Now all of a sudden, I'm down below 50%. Nobody owns 50% of the business. I've been diluted to where I've even lost control. And so in an ownership dilution situation, that's going to influence whether you pay dividends or not, because you may not want to be in a position where you have to bring in additional equity holders, which will then dilute your ability to either control the business operationally or control the business financially. And then the effect of the dividend policy on R sub S. What's R sub S? Required return on stock. So if you remember, the value of any asset in finance is the expected future cash flows discounted at a discount rate which reflects what? Risk. And the expected future cash flows on common stock, if you're the common stockholder, are what? Dividends. Definition of a distribution to a common shareholder of profits of the company are dividends. So in theory, the value of a stock is driven by the expected future cash flow, which is the dividends. That might be a good definition to know. So the expected future cash flow of the stock is dividends. Common stock is dividends. The expected future cash flow of preferred stock is preferred dividends. The expected future cash flow as a bond is interest and principal. And in every one of those cases, the value of those instruments in the market is driven by what's the expected future cash flow discounted at a discount rate representing the risk. In the case of dividend policy, if you're going to pay out dividends and it's a high dividend payout rate, that's going to have an impact on the expected future cash flow, because folks are going, okay, I'm getting my cash, I'm getting it quickly. Cash today generally has more value than cash tomorrow. And so if I'm not getting cash paid out to me today, that hurdle rate needs to be relatively high. The required return on the stock needs to be relatively high, because I might not be seeing those dividends for 5 years, 10 years, 15 years. In theory, companies like Amazon, who have never paid a dividend in 25 years, 25 years ago should have had almost no value. Because when you think about what the discount rate must have been, or the growth rate must have been projected to be so high, and the dividends so high at some point in the future that it justified a valuation back in 1994, 1995, 1997 of many billions of dollars. which meant if you think about 25 years later, it should be in the trillions of dollars in order to justify the valuation. You'll find that a number of folks will look at stocks and go, and we've kind of talked about this, the theory doesn't always hold in practice. But dividend theory says your dividend policy, how much you pay, how much of your retained earnings are paid out, how frequently they're paid, and whether they're paid today or whether they're being deferred into the future, are all going to have impacts on stock price, which are going to have impacts on the required return on that stock. When you have stock, you can do a couple different things with it, which tend to be more for window dressing than actual practical use. There's a stock dividend and a stock split. Who can give me a very quick definition of a stock split? You gotta have accountants in the room. Definition of a stock split.
They issue more shares based on your proportion of the company.
Yeah, very close. So let's say I've got 100 shares of stock and
So
it's
this
trading.
stays proportionate to.
Yes.
Proportionate.
So I've got 100 shares of stock and it's trading at $100 a share. And the company declares a 2-for-1 stock split. Now I have 200 shares of stock trading at $50 a share. A stock split does nothing other than multiply the number of shares and drop the price. So why would a company do a stock split?
It's counted.
Oh, you're way on it. Keep going. People buy more stock. Why? It's cheaper. So here's a classic example. Berkshire Hathaway, which is the company that was founded by Warren Buffett back in the 50s. Berkshire Hathaway has never split its stock because Warren Buffett says it's just funny money, funny baloney, whatever. It doesn't really make a difference. Berkshire Hathaway trades, and I'd have to look at it, trades around $190,000 a share. So you want to buy one share of Berkshire Hathaway, you got to mortgage your house.
It's at $300,000.
Is it? You looked it up? You okay? Okay. 300K. It's very difficult to make an active market in Berkshire Hathaway $300,000 a share. And so a lot of companies go, okay, once it starts ticking up around $100, folks look at it and go, it's too expensive. The reality of it is it's no more expensive now than it was before. You're just getting half as much. But it puts it into smaller bite-sized chunks. It's the reason why you can go to Papa John's and you can get the extra large pizza or you can get the small pizza. Even though the small pizza and the extra large pizza are the same darn thing, and the small pizza is going to cost you more per slice, or per calorie anyway. Oh yeah.
It's not even that good.
Yeah, well, we won't go there. At the end of the day, it's still Papa John's pizza, and you're just paying less for the same. You're paying less for the pie, but you're getting less of the pie. And so, in the case of most companies, they have a policy where essentially to keep active trading, to keep folks feeling comfortable that they can buy round lots, which tend to be 100-share lots. So normally, stocks trade in multiples of 100 shares. Once the stock starts hitting $100 a share, so a $10,000 block, they do a split. 2-for-1, 4-for-1, drop the price down to 25, drop the price down to 50, because as Mr. Chisholm noted, it makes people think, okay, it's cheaper, I can buy some now. It was really more expensive yesterday, but I could buy some now today. And really, the company's the same company, you just have, the ownership is worth half. Each share is worth half of the same percentage. However, the stock price does tend to go up a little bit after a stock split. Why do you think it does that?
There's more of it
There's more of a demand for it. Why?
because it's viewed as it's priced to people that normally couldn't afford it.
Correct. It's priced more accessibly, and what else? What else do you think it does? When you think about dividend policy, what else do you think it does? Because normally the dividend cuts in half too, or reduces. What else do you think it does? If you go back to the signaling theory for dividends, when a company does some of this stuff, the market takes it as a signal that things are going well or things aren't going well. When a company splits its stock, because it's getting up around $100 a share, $200 a share, whatever it is, the signal that sends to the market, the folks who haven't taken this class, is that the stock is doing so well, it's gotten so high, we're going to cut the price down so that it can go back up high again. So it signals that we think the stock price is going to continue to rise, so we have to make it more accessible by cutting the price in half so that people can get back in, because it's going to get ridiculously expensive if we don't do this. And so the signaling theory behind the stock split is essentially we're getting the price down so that we can give it room to go back up, because it's just going to the moon. And so folks tend to look at a dividend or a stock split and go, this is a great sign, company's doing great, they're splitting the stock because the stock price keeps going up, they need to give it more room to go up, put it into a trading range, a price trading range that's going to be attractive to bring in new stockholders, and everybody's happy. The reality of it is, unless dividends go up, really it just cuts everything in half, and the value, the underlying value, the intrinsic value of the stock is unchanged. A stock dividend is essentially, useless. Is essentially the same thing as a stock split, but instead of going, we're giving you 2 shares for every 1 share you have, they may go, we're giving you 1 share for every 10 shares you have. And again, when do you think companies use this?
There's no cash.
Exactly. People expect a dividend, but there's no cash. So you got to give them something. So we're going to give them 1 share for every 10 shares they own. That's a 10% stock dividend. And then in what the company's hoping is, in your mind, you're going, woohoo, the stock's trading at $20 a share, and I just got a 1 for 10 stock dividend. So I got a 10% stock dividend. Now instead of 100 shares, I got 110 shares. So I just made an extra $200. Did you make an extra $200?
No.
Why?
You haven't sold your stock yet.
And so what do you think happens to the price of that stock as soon as that stock dividend goes ex-dividend? It goes down 10%. Because the folks who trade in the market are smart folks like you are. They've had finance class. They go, all you're doing is shell gaming this thing. The stock price will go down by the amount of the expected value of the dividend. So it'll then go down to about $18 a share. But you'll have 110 shares. And at the end of the day, when you add them up together, you got $2,000 or $2,000. Doesn't matter. What do you think happens, or what do you think the signal is when a company does why would a company do a 1 for 20 stock dividend? So let's say or stock split. So you could do splits where you go 2 for 1. You can also go, I'm going to do a split where I'm going to go the other direction. So let's say you own 1,000 shares and it's trading at $1 a share, and I declare a reverse dividend or reverse stock split, and I'm going to do a 1 for 10 reverse stock split. So now you have 100 shares at $10. Why do you think a company would do that? What does artificially inflating the price do?
It sends the signal that the stock is stronger, even though it's the same.
Exactly. So when you're looking at stocks, you see companies that are trading at 50, 60, 70, $80 a share. You go, oh, they're doing pretty good. People are paying $80 a share. When you see somebody, when a stock trading at 75 cents, you're going, that company's in real sorry shape. But in reality, it's not the stock price that's important. It's the value underpinning the stock price. And so companies recognize that there's a sweet spot for a stock price. The sweet spot for a stock price is generally between about $15 to $20 a share and about $75 a share. So think about 25 to 75. Once the stock starts getting above 75, folks go, okay, it's getting expensive. It starts impacting the trading range. And they look at, okay, when do we do a stock split? When it gets down below 25 and certainly down below $10 a share, it makes the company look bad. The signal that it's sending on each side of that is, one is the company's doing really well. The other signal, if the stock price is low, is the company's doing poor. And so if you're going, man, we were doing poor, we're not doing poor now, or we don't want people to realize how poor we're doing, we're going to do a reverse stock split. We're going to take that stock that's trading at 1, we're going to make it trade at 10. We're going to take that stock that's trading at 5, and we're going to make it trade at 50 by doing a reverse split. And we're going to make our stock price go up. Now, none of the underlying value of that stock did not change at all. But the signal that it sends, or the optics of it, changed to the unsophisticated user. So the lesson in all this is stock dividends and stock splits do nothing to change the intrinsic value of the stock, because the intrinsic value of the stock is driven by what 2 factors?
Future cash flows, a discount rate as a representation of.
Yes. The intrinsic value doesn't change at all. It's still, what's the expected future cash flow? What's the discount rate, which represents the risk? That gives me my price. That gives me my intrinsic value. That expected future cash flow is expressed in terms of dollars per share, and you cut the number of shares in half. The dollars per share go up by 2x, but the number of dollars generated by the business operations don't change at all. The risk profile of the business operations don't change at all. You didn't change the underlying capital structure, so the financial leverage and the financial risk didn't change at all. You essentially changed nothing around the theoretical financial value of any of these instruments. The stock is still worth what the stock is worth. You're just dividing it by a different number to come up with a different value. So we just talked about this. I get a little ahead of the slides because I get excited. So you got the psychological range, which again is basically 25 to 75, and none of it does a darn thing on its own, in theory, to impact shareholder value. In practice, it may impact shareholder value for the reasons that were articulated by your classmates, which is folks perceive it to be more valuable. And so it creates a higher demand, which then drives the stock price up and down. Or it may be perceived as I'm receiving something, i.e. a stock dividend, that really has no value, but folks think it does. And so instead of the stock price correcting down by a full 10%, might go down by 5, 6, or 7%, and you actually do end up making a little bit of money. That's why ultimately stock splits and stock dividends are used as part of the capital structure and dividend policy, because they signal things which allow stuff to work with it, or allow the trading to work within the psychological range of, and common stock 25 to 75, and it signals economic value that may not exist, but unsophisticated folks in the market will pick up on those signals and trade on those signals, which changes the supply-demand equation. Any questions on this thing? How many of you think that stock dividends create value? Good answer. So we talked about stock splits. Any questions on what a stock split is? Good. We talked about reverse stock splits. Any questions on a reverse stock split? Yes, ma'am.
What is the difference between, I guess, a reverse stock split and a stock dividend?
So a stock dividend, they're issuing more shares, normally is a percentage. So they go, you've got 100 shares, I'm going to issue a stock dividend of 10%. So I'm going to give you 10 more shares. A reverse stock split means we're taking the number of shares and we're dividing it. So on a normal stock split, we multiply by 2 or 3, so we may split 2 for 1, 3 for 1. A reverse stock split is a 1 for 2 or 1 for 3 or 1 for 4. So for every 4 shares you have, you're going to get 1 share back. You're going to turn in your 4 shares, and I'm going to give you 1 share back. You started with 1,000 shares, and now you've got 10. Now you've got 100 shares because we did a 1 for 10 reverse stock split. Yes, sir.
Is that what it's called? Like, does everyone call it a reverse stock?
Yeah.
Okay.
Yeah, that's common. That's common term. Stock split, stock dividend. We talked about stock dividends. It increases the number of shares that each stockholder owns, but it really doesn't change the economics of it. And sometimes they're used, normally they're used the way Jason described it, which is, we don't have any cash, we got to give you something, we're going to give you a stock dividend. Sometimes they're used to go, okay, we're getting close to 100, we want to keep the trading range not all the way down to 50, we want to keep it around 75, we're going to issue a 25% stock dividend, 30% stock dividend, so for every 100 shares, we're going to issue 30 more, so now you got 130 shares, and it just divides the price by 1.3, and it comes down to back in the trading range. Less used for a stock dividend in practice for that reason, more often used because we've got to give you something, or we want to give you something, or we want to signal things are going well, so we're going to issue some additional shares. Here's the balance sheet effects. For those of you who are accountants, you recognize this. Look at the blue. 100,000 shares at $1 par. So now we're going to do a 2-for-1 stock split. The only, nope. 100,000 shares at $1 par. So now we have 110,000 shares. Oh, that's the dividend. Must have pulled out my normal Monday night. So 100,000 shares at $1 par. If you're going to do a stock split 2-for-1, the new shares, two new shares are exchanged for 1 old share. So what ends up happening is this would go to 200,000 shares at 50 cents par. Nothing else changes. If you have a 10% stock dividend, you have 50,000 shares at $2 par. Now you have 55,000 shares at $2 par. And then your additional paid-in capital goes down by the amount that moved into retained earnings. Same with retained or the amount that went into the par value. Same with retained earnings based upon the ratio of the two. You can see that before the split and after the split. All that happens, our numbers move around on the balance sheet. The total equity number, if you look at this, the total equity number is still $600,000. The total equity number here is still $600,000. They both increase the outstanding number of shares, and they create no economic value. We talked through expectations, and I'm going to leave it there. The last thing I'll talk about, this is in the news, I may touch on this Friday, is stock repurchase. Stock repurchase has hit the news because you're seeing proposed legislation, or folks are talking about legislation to make this illegal, where the company repurchases its own stock. And we'll talk a little bit more about that on Friday. So we didn't mercifully finish, but we're mercifully close. Next Friday. This Friday we do, next Friday we don't. Friday the 24th, I think. 27th.
Yeah.